Hi everyone, and welcome back to another video. So today we're continuing the ETF review series and taking a look at VDY, the FTSE, Canadian High Dividend Yield Index ETF. Last video we just did VFV, the S&P 500 Index ETF. So if you haven't watched that one, go and watch it before this one and then come back to this one because we cover a little bit of topics for beginners in there. So with that being said, let's get into it. So the FTSE Canadian High Dividend Yield Index is basically an index of Canadian stocks that are categorized by higher than average dividend yield. And how that index is built, so if you remember the S&P 500 one, it was just the top 500 companies in the US by market cap. Here it's a bit of a different approach. So it's determined by ranking a set of Canadian companies based on their annual forecasted dividend yield. So the highest at the top, lowest on the bottom, and it's a certain set of Canadian companies. So there's like an underlying index to this one, which is just a global index, and they just take the Canadian part of it. So it's not every single Canadian company, but it's a set of like the big ones for sure. So then you rank it by forecasted dividend yields, and then you basically keep picking them until the combined market capitalization accounts for 50% of the total market capitalization of that set. So we'll take number one. Okay, are we at 50% yet? No. We'll take number two. Keep going until you're at 50% market capitalization. So you get a lot of the big names there. And then the stocks are then market cap weighted. So once you have that set of stocks that made it through that basically screening process, then you market cap weight them, just like the S&P 500 index. So um, as a result, you get a bunch of Canadian companies with very high dividend yields. And from this picture, we can just kind of get a sense of a lot of the companies that are inside of this index. So it's almost this photo, I kind of tried to make it a bit like um, the size of the image is sort of like how how much it takes out of the index. These small ones on the bottom are puny compared to the big banks and stuff. So you have like RBC, Toronto Dominion Bank, Enbridge, Canadian Natural Resources, Bank of Montreal, Scotiabank, Suncor, CIBC, TC Energy, all familiar companies to many Canadians. So you basically have the big six banks inside of here and a lot of energy companies mixed in with a few telecommunications companies like Bell and Telus, and then the insurance companies, Sun Life, Manulife, and Great West Life Co. So these are sort of the companies that um, dominate the Canadian market. In the US, it's like really tech heavy. In Canada, we are generally more financials and energy heavy. So, yeah, but there should be a lot of companies that you recognize here. And actually, fun fact, Power Corporation of Canada, they're a like majority holder of or owner of Wealthsimple. So if you use Wealthsimple, Power Corporation of Canada is the company that's behind it. So. Yeah, so we'll continue here. So VDY facts. So it's traded on the Toronto Stock Exchange. Its inception date is 2012, November 2nd, 2012, which is actually the same date as VFB. So they were launched on the exact same day. And instead of quarterly distributions, we're looking at monthly distributions here. And MER that is pretty reasonable, 0.2%, and assets under management of $2.39 billion. And we can see since inception, the total return as of recording is 187.02%, and that's with dividends just reinvested. So there is some competition for VDY, which is managed by Vanguard, and has that 0.2% MER, like we said. Out of its competition, it's the biggest fund with that AUM of assets under management of 2.39 billion. And its main competitors are, and this is probably, I think its number one competitor is, yeah, for sure, XEI um, from BlackRock. And this is the one that like usually most people compare to VDY, and there's like lots of debates on like which one is better, but we'll get into that. It has a slightly higher MER, and then you have XDV from BlackRock and ZDV from BMO, which are its next two closest competitors in my opinion. So there's two BlackRock funds and one BMO fund, but these two, the MERs are very high on them. Like I was surprised like why these are so high. So like XDV is like 0.55%. That's quite high. It's more than double VDY and XEI. So, and then ZDV is similar nature, really pretty high for like what it's doing. It's just a select amount of Canadian companies based on dividend yield. All of these are just selecting um, Canadian companies on dividend yield, and I don't see the point of having fees in this high of a area. But we will see. With performance, even with these MERs, they're not able to outperform VDY. So VDY is definitely my pick from the competition here. So, but just an overview, if you have that MER of 0.2%, you'll pay just $20 annually on a $10,000 investment, and it comes out of the fund automatically for you. You don't have to um, mail Vanguard a check. They just take the money right out of the fund for you. And in my case, I own about just over $25,000 worth of VDY, so I'm paying about $51.25 annually to Vanguard. So definitely, it's higher than VFE for sure, but I think it's the best like way to get really good exposure to the Canadian market. So, and then we see here, so yeah, and it has the lowest fee out of the competition. So now we're going to look at the total return for these four funds, and VDY is the clear leader of the pack. Um, like I said, XEI is like a very close comparison, and it's not too far out, but like over 40% is still decent. And then you have XDV and ZDV with their high MERs, like dragging them down even a bit more. No, obviously it's not just the MER, it's the selection of funds, but yeah, like out of these four funds, VDY has been proven to be um, the best of the bunch, like over a decade now, track record. So honestly, like when selecting these funds, I think there's a clear winner here. So why invest in VDY? So I think it's a great method to add quality Canadian equity exposure to your portfolio, and it's added diversification beyond your core US exposure. So very important here. So and we'll see. Actually, well, I'll come back to the slide here. Like your the core of your portfolio, in my opinion, should be the United States. Like we discussed in the last video, like how powerful the United States is. All those companies like Google, Amazon, Tesla, Meta, Microsoft. These are massive companies that have huge impact, have a huge impact on the world. If I'm being honest, like in the Canadian market, like RBC, like does it have a massive impact on the world? Well, it has a great impact on Canada, but its reach outside of Canada is like very little, and it's not really providing as much. Like a lot of the Canadian companies, they provide a lot of value to the Canadian economy, and then it stops there. Like I'm sure the energy companies, the energy companies have had a really hard time bringing um, their like resources to market. Like if there were regulation changes, I think the energy companies could definitely see a huge bounce in Canada if they were prepared to export more oil. However, as it stands, a lot of these companies are just providing benefits to Canada, to be honest. Like nowhere near on the level of the companies inside of the S&P 500. So accordingly, like I think this is perfectly fine. Like I think it makes sense that the valuations for the American companies that are providing global benefit for the entire world are going to have higher valuations and higher total returns over time. So you can see VFV is it's no comparison. It's just blowing VDY out of the water. But does that mean you should just invest? Oh, I'm going to just invest 100% DFE now? No, that's not what you should do. You should definitely diversify outside of the US because, I mean, it's not always going to be like this. You don't know, like, do we know that the United States is always going to be king? Like, um, we have no idea. So, it's good to diversify outside of your, outside of the US. But I want to make a point that the US should definitely be a core position inside of your portfolio. And in my case, it makes up quite a bit, like over double my Canadian exposure. So yeah, definitely capture a lot of that total return in your portfolio from the US market, but then it's good to diversify outside of, even if it comes with lower total return historically, your future self might thank you for doing so. So in addition to that, VDY does have high monthly income through those dividends. So you had like a 4.5% plus yield. I think it's been even getting close to 5% or even above 5% at times with the secular yields. So like if secular is just like that month, how much it was yielding. So like sometimes I've seen it over 5%. So yeah, it's very high in monthly income through those dividends. And to be honest, it can be very motivating during market downturns to continue to see your monthly income rise. So as you keep investing, you're gonna see your monthly income increase when you're buying VDY, which if you're seeing all your stocks go down in value, like which was like the beginning of my investing experience, everything was going down. Like I literally started investing right at the top of the right at the end of 2021. So that right at that peak, like when I started investing, I didn't see like any positive return for like over a year, but now I'm like up over $20,000. But during that downturn, like it's hard to stay motivated when you just see like you're red everywhere. So when you have that income, that snowballing income coming month after month without you having to do anything, it's very motivating as well. It can have a good psychological effect, and at the end of the day, having an income snowball is value on its own without having to like sell your stock. So it's actually, if you're an income investor or a hybrid investor like myself, who likes the income strategy in addition to the growth strategy, but like always prioritizing the growth, but having a bit of income. I think this can be a good fit in your side of your portfolio. And like I said, with the competition, there's a sizable track record of outperformance relative to its competition, and I think it's a clear winner among those. So that could be a good reason for you to invest in VDY. So that's about it. So thank you for watching, and I'll see you guys in the next video.